Welcome to the Money Mentors Podcast.
Thanks for clicking play here on the Money Mentors Podcast. Remember, if you are looking for retirement and investment lessons along the way, this is the place for you. So hit the subscribe button and let us know if you have any questions for your money mentors at matsonfinancial.com. Meme stocks. We've been hearing about that quite a bit lately in the news. Now, these are stocks that dominate social media discussions and therefore gain quick popularity in the market too. So my question for you, are there still ways to invest in this upward moving market right now without taking on all the risk of something like one of those meme stocks we're hearing about?
Well, the fact is that if we hear it either on the radio or social media or whatever is going on, generally speaking, when that happens, it's already taken place. In other words, you're too late to the party. It's one of those things that, again, with GameStop, there's a few people out there that really drove that. And when it drove it up, and of course, there's people out there that really got hurt because they thought it was a failing company. Right. Then you get into it, and then it goes down. The people that brought it up sold it. And of course, what happens? You're one left leaving the money on the table, or you're losing the assets. So we don't like those type of things, especially for retirees. We want something kind of more of a steady situation that we can count on it. And we do move money around depending upon opportunity. So generally speaking, if the market's going up steadily, we're going to harvest the gains. In fact, this last 2 weeks, we've been harvesting a lot of gains for our clients due to the fact that the market is up relatively nicely, and we don't want to give those gains back. So what we're looking for is stuff, again, investments that are going to produce over the long haul and not just one issue. So generally speaking, we're not going to buy one stock. We may buy several stocks of the same type of companies. In other words, that if we're investing for dividends, we're not going to buy just one company, have all the money there and getting a good dividend, because things could change so much on that one company, just like we're talking about insurance companies earlier. So we want to have a diversified portfolio going into the areas we want. And that way, if one company fails, that's why we call it diversification, we're not so concerned or harmed unless the whole energy sector went down, for example, or a whole computer sector, microchips, those type of things. So you'll see some companies doing very well and some companies not following suit. We're seeing some companies out there really doing very, very well and beating market analysts, and of course that stock goes up. The time to buy it isn't when they announce the dividend and it's going to be better than the market expected to go out and buy that. That's called day trading, and generally they don't last very long. Day traders have been something that's out there, but they don't make it in the long term because of the same reason like Jeremy was talking about. You grab something, it's going to go up, and you're going to hold it too long because you don't know when to get out. So if it's something that you don't know when to get in and get out, that's called timing. And I don't know about you, but I'm horrible at timing for myself as well as my clients.
Absolutely.
So we want to be more consistent. We want to see returns in that number of 10, 12. Last year we had some great returns. And once again, we harvested those, put them in a position that we can still make money, but we're taking some of that risk off the table. Right now, I still think the market's got a lot to give yet, and especially the U.S. market. And so we're fully vested in equities. And once the Feds do lower rates, I think the bond market's going to get hurt.
Yeah. Well, it's interesting to hear you bring this up, Gary, because we know that meme stocks are just one reason that the Dow recently shot up past 40,000. And it's kind of a psychological milestone of sorts. But interesting to note, it took less than 4 years for the Dow to climb from 30K to 40,000 and just over 3 years to make the move from 20 to 30K. So we've probably seen our investments go up quite a bit if you look at your own portfolio over these last 7 years as well in correlation with the market. But it might make some people wonder right now, why would I want to make any changes? I mean, things are looking good. I open my statements, I'm up. Why would they want to make any changes?
Well, we go back to the old saying that pigs get fed, hogs get slaughtered. And what that means is that, when your portfolio is fat, you should be taking some of that off the table and putting it elsewhere, because when the market does change, and it will, when it goes down or stays flat, then you're in a position to either buy more or use those assets for income. And if you're having a robust year, which we are, you want to make sure that you're taking advantage of that. Give an example is that we're taking some of the gains we made this year in the energy field. We've done quite well in that. And we're taking those out and putting them into some of the digital assets that are available out there. So once again, taking gains that have been making money, go into another area we think is going to make money. So we're making money on top of money. That's called compounding return, and that's where clients want to be.
Real life lessons about your retirement. You're listening to the Money Mentors Podcast.
Now, I know we are at the midway point here in 2024. Seems like we're still a long way from 25, but already we are getting some predictions about what's going to happen with the Social Security cost of living adjustment, or COLA, for next year. Now, the latest projections put it around 3.2% based on current inflation numbers, but we know Social Security is just one piece of that retirement puzzle you put together for your clients. So how do you help them keep up with the real cost of living, which I still argue is going up faster than what the government's telling us?
And it's really about the math. We talk about it so much as the factor that we want to have assets available to meet clients' retirement needs. So you can talk about gas going up for your vehicle. It can talk about a new car you're going to need in the future. Maybe it's even just vacations that you're going to do with family members. These are all the real questions we ask at the beginning of meeting you, and continually ask those every single time we get together. What's coming up that you're planning for? Has anything changed? That allows us, because again, we're tactical investors, meaning that we're going to change the investments you have based upon market returns and what's going on with you for income. So if that's something that we're planning for a year from now or 2 years from now, or maybe right around the corner, what does it matter to you is going to be very important of what your portfolio is doing. So many people make the adjustment out there that they're putting money in municipalities for bonds, and they take the money out of those to pay for their taxes each year. And what you're really doing is not allowing the money to grow enough so you can actually replenish those funds. And that's so important that you don't want to give up the principal. You want to take from the growth and continue that. And that growth has to exceed, again, what's going on with inflation. So if you retired, let's say today, 24 years from now at 3%, and you're taking out just like a modest amount, that modest amount might have to be starting from a $2 million account, not just a $1 million account.
Right.
So you might say, well, gee, my advisor did really well and doubled my money in 24 years, even I take things out. Well, that's true. However, they just kept you at the same buying power.
And that's the scary part, I think, right now, is we watch these monthly numbers come in, 3.2% in the latest inflation report. That's on top of the huge increases we've seen over these last 2 years. And I don't know about you two, but the Federal Reserve, it seems like it's frustrating them at this point. So it has to be super frustrating for us who are trying to keep up.
Yeah, and I think that's the hard part about it, too, is because we want to react to those situations and that information that is coming out. And so we're going to do that with the best of our ability of what information is there. But when it comes to our plans that we lay out, you're going to see, if your annual income, you want that to be $80,000. Well, we're going to build in that cost of living adjustment for what we've seen in the past years and make sure that your income goal is going to increase every year. I have seen it where clients who are now clients of ours, when they were prospects at that time, not clients yet, they came in and brought their original financial advisor's income plan, and that $80,000 was $80,000 every single year. They didn't build in that adjustment. Also, ours goes into, consideration of if you have an IRA or another pre-tax account, or really any account that's going to continue growing, what does that value look like if we were to make sure it's really conservative? But then that means with the IRA and the 403Bs, the 401Ks, those pre-tax accounts that continue to grow, what does that look like in your 70s when you become of age of required minimum distributions? Mm-hmm. We put all of that into this, all these factors into this, so you can see layer by layer, year by year, what does the RMD look like? What should we do with Roth conversions, if that should apply to you or not? And this cost of living adjustment piece.
It's huge. And I know you also talk about Social Security, too, what to expect from that. What's the maximum benefit? You lay out the pros and cons of when to claim. But important to note, too, as I was reading up here on this Social Security COLA, Gary and Laurel, a lot of people don't realize that, yes, they might give you that raise every year in your benefits, depending on what inflation's doing. But typically, isn't that eaten up by some of those Medicare premium hikes, too?
I was just going to say the same thing, is that if they're raising on one side, they're going to raise on the other.
Right? Yeah. So
Yeah, so you might say, okay, well, I'm getting a 3% on $2,000 Social Security, so yeah, you're getting an extra $60, but your Medicare might rise to $65 because of inflation on that side of things. So once again, it's making sure that the numbers balance out, and if it doesn't, that money's got to come from somewhere if you're going to maintain the things you want in retirement. So once again, it's so important, like Laurel said, to have the plan in place to show where the numbers are going to come from, how it's going to work over time, and truthfully, what you're going to have left over.
And it's great, too, because if we talk about how Medicare premiums might change or what that looks like for you, we have our own licensed agent who focuses and specializes in Medicare. So we can have those conversations right here in-house to say, you know, if income levels here, what does that do to their Medicare premiums? Or how do we change this? How do we work on a best case scenario for the client? We're trying to take all of that chaos that you might have to incur yourself to have those conversations between your health insurance specialist and your advisor. We're bringing that together on your behalf for you.
Want weekly lessons from your money mentors? Yes. Hit the subscribe button now and listen every weekend on Wood Radio.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Fee-based financial planning and investment services are offered by Matson Financial Services, LLC, an SEC-registered investment advisor. Insurance products and services offered through Lakeview Financial Group, LLC, Matson Financial Services, LLC, and Lakeview Financial Group are affiliated. To find out if Matson Financial Services is licensed in your state, please call 800-536-8907.